Have you ever wondered what happens to your money after you put it in a bank? Banks are more than just safe places for our cash. They are a core part of our economy. They keep our money secure. They let us pay for things without carrying piles of cash. They also help us buy big things, like a house or a car, by lending us money. These are the basic jobs of a bank. They help money move around, which helps everyone. Without banks, our modern world would look very different and much more complicated for everyone involved in buying, selling, saving. A bank is a business that deals with money. Think of it like a special kind of store. Instead of selling clothes or food, it sells money services. Its main job is to take in money from people who want to save. These are called deposits. Then the bank lends that money to other people or businesses who need to borrow it. Now that we understand what banks do, let's look at who watches them. In both the United States and Europe, banks are not free to do whatever they want. There are special government groups, called regulators, that set the rules. Their main job is to make sure banks are safe and play fair. They want to prevent a bank from failing and causing problems for everyone. These rules cover everything from how much money a bank must keep in reserve to how it treats its customers. The goal is always to protect the financial system and the people who use it. In the United States, the system of regulation is quite complex. It's like a patchwork quilt. There isn't just one single regulator for all banks. Instead, there are several different agencies. The Federal Reserve, the Office of the Comptroller of the Currency, the Federal Deposit Insurance Corporation. The type of bank and where it is located determines which agency is its primary watchdog. This system grew over many years, leading to a sometimes overlapping and confusing structure. Europe has taken a different path, especially after 2008. They created the banking union for Euro countries. The ECB now directly supervises the biggest banks across these countries, aiming for a single standard. The US is fragmented. The Eurozone is more centralized. This affects everything else. Let's move on to a question that worries many people. What happens if my bank fails? This is where deposit insurance comes in. It is a promise from the government that your money is safe, up to a certain limit, even if your bank goes out of business. This is one of the most important features of modern banking. It gives people confidence to keep their money in a bank instead of under a mattress. It helps prevent bank runs where everyone tries to pull their money out at once, which can cause even healthy banks to collapse. In the United States, this safety net is provided by the Federal Deposit Insurance Corporation, or FDIC. It was created in the 1930s after thousands of banks failed. It guarantees deposits up to $250,000 per depositor, per bank. If you have $200,000 and your bank fails, the FDIC makes sure you get it back. Europe also has deposit insurance, but the system is different. Across the EU, deposits are protected up to $100,000, run by national deposit guarantee schemes. That's different from the single large federal fund of the FDIC. Both systems protect savers. Europe has debated a single EU-wide scheme, but agreement is difficult. We have talked about regular banks and regulators, but there is one bank that is more powerful than all the others. This is the central bank. A central bank is a special institution that manages a country's or a region's money. It doesn't serve regular people or small businesses. Its customers are the commercial banks. Its customers are the government itself. The central bank's job is to keep the economy stable. It does this by controlling how much money is available and how much it costs to borrow money. These decisions affect everyone, big companies, individual savers. In the United States, the central bank is the Federal Reserve System, created in 1913. Its most important job is to set the main interest rate for the country. When the Fed raises this rate, banks pay more to borrow and pass it on to mortgages and loans. When the Fed lowers the rate, borrowing becomes cheaper, which encourages spending and investment. The Fed also acts as a lender of last resort to prevent the system from freezing up. Across the Atlantic, the European Central Bank serves the Eurozone. It is younger, founded in 1998. Its legal priority is price stability. ECB rate decisions affect Portugal, Ireland, Finland alike. The ECB also supervises the biggest banks, a dual role. The Fed has a dual mandate, price stability and maximum employment, while the ECB's primary mandate is price stability. One rate must fit many economies. Now let's explore how banks actually make money and where they get their funds. A bank's business model is its plan for making a profit. This plan depends on funding, deposits from ordinary people, or borrowing from other big financial companies. American banks, especially smaller local and regional banks, rely on customer deposits. This is very stable. The deposit-funded model is safer and more traditional. But giant U.S. investment banks use more wholesale funding, borrowing large sums in markets, which can be less stable. European banks tend to rely more on wholesale funding and central bank loans. Many are universal banks doing retail, corporate, and investment banking. Their funding needs are huge, so they borrow from markets, making them vulnerable when markets get nervous. In a crisis, market funding can dry up quickly. The ECB has provided large-scale liquidity support. The U.S. has a wide diversity, from tiny community banks to global giants, while Europe is more dominated by large, complex, universal banks. Bottom line, deposit-reliant systems can be more resilient in a panic. Market-funded systems can be efficient in normal times but fragile under stress. For most people, buying a home is the biggest financial decision of their lives. The loan is called a mortgage. How mortgages work, how you get one, what kind you can get, what happens to it, is very different in the US compared to Europe. These differences reflect deep structural variations in their financial systems and legal traditions. In the United States, the most common mortgage is the 30-year fixed-rate loan. The rate stays the same for the entire term, giving great certainty. This is possible because banks often don't keep the mortgage. They sell it to government-backed entities like Fannie Mae and Freddie Mac, which bundle thousands of mortgages and sell them to investors. This process, called securitization, keeps money flowing. In Europe, markets are fragmented. Long-term fixed loans are less common. Many mortgages reset every few years. After the fixed period, the rate moves with the market, adding risk to homeowners. European banks often keep mortgages on their own books, tying up capital. The U.S. system enables predictable payments for millions, though the 2008 crisis showed securitization can create huge risks if mismanaged. Europe's approach can be simpler. Your bank keeps your loan, but offers less certainty and can slow new lending. Your home loan experience is shaped by these architectures. Let's switch from big loans to small, everyday transactions. How we pay for coffee, groceries, and online shopping is shaped by the banking system. Payments are changing fast, with new tech replacing old habits, from credit cards to mobile apps. The US and Europe took different routes, leading to different habits and competition levels. The US is credit card dominant. Visa, MasterCard, American Express. It's profitable for banks via interchange fees, which are higher than in many regions. Debit is popular too, but rich rewards and protections make credit cards a favorite. The US adopted chip and PIN and contactless more slowly than Europe. Europe favors debit and has capped interchange fees, lowering merchant costs and enabling national payment schemes that compete with card networks. Europe pushed open banking rules so customers can share data securely, spurring fintechs to help you budget, compare products, and pay straight from bank accounts. The US moves more cautiously and market-led, while Europe is regulation-led, producing different speeds of change. Following on from payments, let's look at FinTech, technology improving and automating finance. This spans mobile banking, online investing, new lending, and cryptocurrencies. The US, with a massive single-language market and deep venture capital, is a powerhouse. Silicon Valley produced PayPal, Stripe, Robinhood. The US often runs a sandbox model. Let ideas grow, then regulate, fueling speed and risk. Europe is top-down and regulatory-driven. Open banking and PSD2 forced access, birthing startups like Revolut and N26. US fintechs often optimize within the card system. European fintechs build alternatives that bypass cards entirely. Both approaches have strengths and are pushing finance forward. As we have seen, the US and Europe may look similar on the surface, but they are built on different foundations. From regulation, to how you buy a house, to how you pay for coffee, the differences are real and they matter. The US is a complex patchwork with huge variety, fostering innovation and unique structures like the 30-year fixed mortgage. Europe, especially the Eurozone, has centralized supervision under the ECB and pushes toward a unified market via regulation, competition, and consumer protection. Trade-offs. US fragmentation brings dynamism and potential gaps. EU integration brings stability and slower adaptation across diverse economies. These aren't academic differences. They affect stability, borrowing costs, and your choices as a consumer. In the end, both systems share the same goal: move money safely and efficiently to fuel growth and prosperity. Different paths, same destination, and the journey of money is far from over.